Guys, it's April the 3rd, and today we are going to be talking about Amzn Q4 earnings. This one is one of the more controversial ones for sure, which means that us option folks are going to have a really, really good time. So now I'm going to start sharing my screen, and I want to let you guys know as well that this is probably one of the more exciting episodes for me because I am collaborating with some of my favorite people on Clubhouse, which is live trading with Dr. A and friends. If you guys are kind of more on the beginner side of trading and you want to up your game, I think this is a wonderful place because they do not only live daily sort of Q&A with some great folks that have tons of experience in the marketplace, but they also do a lot of these kind of educational rooms, of which I'm really thankful to be a part of one of them. There is a paid version of Markets with May there where you can get live Q&A with me. And also, I definitely want to give a shout out to Rich, who will be starting his room as well, 9:30 on Monday. And then if you are watching this on YouTube, it's amazing every time if you like, share, comment, especially if Amzn is something that is high on your watch list and you've got some thoughts. So let's get into what's going on with Amzn here a bit and why I chose it to talk about. And the thing is, right now, we've just got so much market volatility, but you might think that that's what's causing the volatility at Amzn. I might argue that there's even more to it than that. This was a very, very controversial, in my mind, Q4 earnings call because the disconnect between how I'm seeing it reported, how I'm seeing it spun, and what I actually saw in the financials is greater than any time I've ever seen before. Here are some of the articles that I think summarize what's up and what's going on as relates to what's going on in the stock and how you might want to be thinking about it. And here, there is this article that I pulled off of Seeking Alpha just the other day, accelerating cash flows and attractive valuations. We're also seeing Amazon holiday season best ever earnings report backed up the idea that the online retailer is not being hurt by cutbacks in consumer spending. And then you've got Dan Loeb, who's really one of the greater professionals, to go through what I'm seeing so that you, the investor, can make your own decision. It does indicate that the options market's going to be really fun as relates to Amzn, especially as we go through to when their earnings date is. Now, FANG stocks will tend to report the last week of April, first week of May. So there's really nothing in between those two dates. And if anything, we're in what's considered the quiet period. So the only people talking will be the news flow folks, or alternatively, different people that are being interviewed. And that will probably mean that it's just really volatile. These actually are from publications that you would usually trust, but I'm just going to show you how crazy it is. Accelerating cash flows and attractive valuation. Is this true? Actually, one of the intriguing things about Amzn is they tell you more about cash flow than you'd ever think that would matter. But here's the cash flow charts that they went over and over and over again in every single quarter last year, which would be the metric that a lot of folks that are doing kind of a very particular type of fundamental modeling would be looking at. And you can see clear as day, that is just not a true statement. You have significantly decelerating cash flow this quarter. And we are going to go through that. There's a reason why they show it with finance leases and principal repayment payments, and they show it just without all of that. I'm not sure why that was the headline. I would say that if you are excluding this last year and go backwards over the last 5 to 10 years. So maybe if your horizon is different, you will see some acceleration in cash flows. But I think this year in particular, we did not see that. There is cash flow from operations in particular, which I would find very important when you've got a retailer and you're making certain types of claims. And you can see very clearly the last 12 months, $20 billion less cash flow than there was the year before. And the fourth quarter, which I think is very disappointing for folks, because if you think about it, if you're a retailer, the fourth quarter is where you make your money. That's the Christmas holiday season, whether it's Christmas for certain countries or any number of other holidays that are celebrated overseas. This is not positive cash flow, operating cash flow. Some of the folks have talked about the fact that, you don't get it, everyday investor trying to look through the financial statements, because all of that is actually them heavily reinvesting in the business. And so, you just don't get it. Here is actually from the transcript of the Amzn earnings call. And he talks about the fact that the numbers have grown over the last few years in capital expenditures, and that most of it is going to AWS, and that he's actually going to talk about it with both the operating leases and capital expenditures together. Look at that. What that means is you got to take a look at the balance sheet. We look at the balance sheet, it grew, as you mentioned, in PP&E, right? But if we're really talking about the fact that this company uses a fair amount of operating leases, et cetera, then we do have to then really discuss the operating leases item. And if you think about it, if you're a company that's going to have warehouses, trucks, et cetera, it would make sense to finance them instead of doing it in this one cash lump sum payment, especially because if you're a retailer, you might need that cash for something else. So it's really these two items that have to be taken together, and you can then see how that cash flow leads through. It's not an insignificant, these finance leases are not insignificant, and you can see how much that grew this last year. So this idea that they're investing in the company, it's a one-time charge, I'm not 100% sure. Now, the other place that you should and could look at that just to see if you agree or disagree is this, which is the debt vintage breakout that's in every single annual report. When you go to look at that, you'll see the long-term debt and interest payments are small, right? And your operating lease liability is significantly larger. These two are significantly larger relative to that. So this idea that this capital expenditures are one and done and Mei Ling doesn't understand it for whatever reason, I'm not convinced. I'm not saying it's not true, nor am I saying that it isn't the right call and the best thing to do. But I did want to just point that out to those that would just completely disregard this free cash flow number as a one-time situation that is one and done. I'm not convinced that that's the right way to think about it. Let's say it that way, because you still have, it's a really big decline. Let's talk about whether it is valued appropriately or inappropriately, or how you want to do it. And before you do that, you kind of have to realize that anything that's in the financial statements is backward looking. So we're really talking about forward looking. So I'm going to start with what the company actually guided. And what they actually guided was to grow between 3 to 8% compared to the first quarter of 2021. And that there's still an unfavorable impact of 150 basis points from FX exchange rates. And this was on early February. So we have not yet incorporated the rising oil and gas prices that have occurred. We have not yet incorporated a war in the Ukraine and whatever's going on in Europe associated with that. So just realize this is the guidance at that point in time. And then you've got operating income that expected to be between 3 and 6 billion compared to 9 billion in the first quarter. So they essentially guided down, even though there's a ton of articles that are suggesting that they guided something other than down, or they did better than expected or whatever it might be. So just realize this is the picture that we're looking at coming out of the fourth quarter. So that is really starting to address this. I'm going to take attractive valuation and best holiday season together and kind of walk you through how someone like me might look at that if I'm trying to assess it for my own positioning, or if I'm trying to assess it for somebody who's asked me, May, what should I do? Should I hedge this thing? How should I think about it? What my existing position? I can't sell it because I've owned it for so long and I'm sure not going to take capital gains on it. What should I do? Here's the income statement. Best holiday season ever. Okay, here's product sales and here's service sales. And as you can see, product sales are really only up 50 basis points, right? That's going to be the gift giving. Now, in fairness, service sales could be things like you want to give someone a book, you want to give someone an Amazon Prime membership, you want to give them whatever it is, right? That's cool. So that absolutely did grow in some ways, and we're going to get to that a little bit because the Amazon did a fantastic job of breaking that out pretty well. But this right here, to me, when I look at this is flat. And the services business, now remember the thing in this breakout, because they give you several different breakouts of top line growth. This right here on the service sales is going to include Amazon Web Services, which grew very, very tremendously. But up here, this is a clean number that you can compare to other retailers. So that's what I decided to do, was compare it to other retailers. Okay, this is Walmart. 40 basis points does look a little bit like that, right? But 50 basis points with their membership income. Here's Kroger's. If you want to say, hey, May, the products business is a lot of grocery stores, things like that. Kroger's grew at 7% revenue growth. Inflation is what did it for them, okay? TJ Maxx, 26% top line growth. So that's going to be the fact that folks are saying, hey, it's cheaper to buy on Amazon than something else. So, but, actually discounters did extremely well. So that kind of is what it is. And then on Target, that grew at 9%. But what is going to matter ever so slightly more is whether or not those businesses were profitable. And in that regard, unfortunately, I wish they would have done it where it was product sales and then the profitability of those product sales and so on and so forth. But that's not what happened, unfortunately. They then split it out, this North American, international, and then AWS separately. So this is North American sales. 2 months ended, 12 months ended. So was the fourth quarter profitable in North America? So that question is no, it was not. And then the question of was international profitable was international profitable for Amazon as relates to its non-AWS business? And the answer to that question as well is no, it was not. And if we compare that to Walmart, the US business was profitable, but Walmart really basically puked out everything it could on the international side. As you can see, it was not profitable in international for Walmart. So this is a fairly decent compare and contrast. Walmart ends Jan 31st, by the way. Here is what we're seeing for the various areas as relates to the fourth quarter. And you can see physical stores were up 17%. That's primarily the Whole Foods business. If you look at online stores, that was down 1%. So the online business was not growing in the fourth quarter. And subscription services, which is going to be everything outside of AWS, and advertising services grew a lot. Third-party seller services did grow at 11%. Now, third-party seller services and online stores, that's going to be very relevant for what I would call the core business, right? Because here we're looking at $137 billion worth of sales. 100 billion of it, more or less, is coming from those two areas, and the rest is much smaller. So a lot of the articles I noticed were really highlighting all the gems that happened. And some of them talked about the third-party seller business. Very few talked about this piece, which is that online sales were actually weak on the quarter. So this was not necessarily the best looking quarter as far as the idea that the holiday season was its best ever. When we look at this, the physical stores is growing at 17%. So what are we seeing there? We noticed that Amazon shut its bookstores and it's really expanding its grocery chain. So it's a little bit hard to really understand the strategy on what's going on in the 17%. It sounds to me like Whole Foods is doing fantastic, and maybe the other objectives, maybe not so much. When you do then look at this, was it a great holiday season? A lot of folks have reported this in a particular way. This is really hard for me to say, oh, it was a fantastically profitable season, because you do have operating income down by about 50%. This is very bad in my mind, because there are very few retailers that had that sort of experience during the holiday season. Here are the other retailers' operating margins, operating income. Okay. Walmart, even though it only grew at 50 basis points, 0.5%, was able to get operating margins much higher than that. And it actually grew operating income about 7.3%. Now, Kroger is not comparable. It ended up having a 2.9% operating margin, but because they went negative in 2020, they're positive moving into the green again for the fourth quarter was just fantastic. You know, so if I were to use that number, it would just look astronomical. Same thing with TJ Maxx. I mean, it looks like a 34 times, like 3,000% increase, because the fourth quarter of 2020 was so bad. Now, Target's been doing great all along, and they have like 14% growth on the bottom line. So the idea that operating margins compress this aggressively, that's not normal. As relates to, if we're talking about, was it a great quarter, best ever, that sort of thing, I think that's I think it was a best ever in the sense that they dealt with a lot of issues that were really terrible. They had to exhibit a lot of teamwork to do that, and, et cetera. And certainly the web services business, which grew tremendously at like 40%, advertising was fantastic. These like, I'm almost saying businesses that they're certainly growing out, they did wonderfully, but it's hard for me to, from what I'm seeing, to feel like this number, which is down 50% operating income, constitutes fantastic results. So that is part of what I think will make this earnings season very, very controversial. Now, one other thing that really comes down to the bottom of how do we think about these two things is really what's going on as relates to how you would then look at Rivian, right? Like, how do I look at all these numbers, X Rivian, what have you? Well, and there's a couple different ways that people do this calculation, but Amazon with Rivian is trading at 44 times. And for context, most of the retailers trade around 20 times, something like that. So it's trading about twice that of a retailer. But realize too that even the other FANG stocks have 30 times earnings, and then they don't have an operating income decline from this year. Did the math for you on the right. If we took out Rivian, realize that this 44 times that Amazon is trading at includes this one-time gain. So everyone wants to focus on the one-time expenses on operating. I really am surprised that no one's focused on this one-time gain of Rivian, which is $11.8 billion. Okay, operating income for the year was only $38 billion. And so the math looks like this. Net income minus Rivian, you can look at their tax rate. And since that's nothing, essentially, you really can't, there's no need to do a lot of additional math on this. The market cap of 1.6 trillion and divided by net income, you end up with a stock that's trading at 64 times. But anyways, there aren't a lot of tech stocks that are of this size that trade at 64 times and show 9% top line growth and operating income that's declining. So that's my beef as relates to the news flow release items that are talking about how they have an attractive valuation. I'm not sure what it is they're looking at. Now, the last thing I'm just going to address, and then we can go to Q&A, is Amazon is worth $1 trillion more. And I have so much respect for Dan Loeb that when he said it, I was like, okay, let me just do the work. And I think what's happening here is there's a time horizon that's associated with why folks think that just the Amazon Web Services business is worth $1.5 trillion. So there are different ways that you can do valuation, and one of them is relative value. Another is discounted cash flow. So it's possible that on a discounted cash flow, he sees a very different number. I'm going to go ahead and admit that. But in options world, our time horizons are different. So relative value is as relevant to trying to understand, given a highly volatile marketplace, what is the market saying that business is worth? Just like if you were in the supermarket and even if you would have gladly paid $2 for a quart of milk or whatever it is, if they're selling it at $1.70, that's where they're selling it at. Here is probably one of the most comparable businesses to Amazon's web service business is Microsoft's cloud business, which is Azure plus all of the other things that are offered as a function of Azure. And as you can see, Microsoft in the 10K, this is where this comes from, breaks out that business. It's called the intelligent cloud business for them. There's maybe a couple more things in it, but not really. And you can see that the revenues from that are 62 billion. So 62 billion, 60 billion here. I'm saying they're comparable businesses. And the first thing I'm also going to do is just look at what are the operating margins of Amazon's business versus Microsoft business. And when I go to do that calculation, so that's just 18.5, which is what they made, divided by 62. And over here, it's going to be, this is operating income. This is actually the wrong number, 26 divided by 60. And when I do that math, I have the operating margin of Amazon Web Services being about 30%, healthy, very exciting. And then I have Microsoft's Microsoft Cloud business at 43%. This again comes from Amazon's Q4 statement. This comes from Microsoft's 10K. You guys can look this up if you'd like to. And now you also want to kind of think about with valuation, what is the percentage of revenue that the cloud business represent? And then what is the percentage of operating income that Microsoft represents? And there, if you do it as a percentage of revenue, 35% of the valuation ought to be attributed to just the cloud business. And if you're going to do the percent of Microsoft's market cap that is due to the income that it receives from the cloud business, that's 37% of the market cap then should come from the cloud business. So the framework that I'm talking about here is if I'm going to say Amazon Web Services as a standalone is worth blank, then I should be able to find a comparable business that is worth that number. And so with Microsoft, it has a market cap of 2.35 trillion, of which the cloud business represents, let's call it 36% of the business. Now, when I do that math, I get 841 billion, if we use it as a percentage of revenue, is the value of the cloud business to Microsoft. And I get 879 billion is the value of it from operating income. that's a relative value approach. Now, is it the right approach? Is Microsoft undervalued? Are we thinking about Microsoft wrong? And that's the real problem. That's very hard to say. And certainly I like Microsoft as a company. I do actually own a little bit of both of these, quite frankly, which is why I'm happy to do a little bit more deep of a dive on it. But I'm surprised. I really do feel like perhaps that commentary is taken out of context. I'm not sure that he meant it was worth that right this minute. And if it were, when I read the article, he was suggesting maybe that they would spin out the web services business, which, okay, cool. If they did, if they got a $1.5 trillion valuation, I think it has more implications to Microsoft than it even does to whether or not that business is correctly demonstrated. So that would be the third piece of these three claims that were made in the press. Now, I'm not really disputing how other people are seeing it. It's more just when you get the news flow sometimes from earnings, and if these are, long-term holdings that you're going to hold on to and buy, how should you then think about it for yourself? In a lot of ways, I would say the reason I still have some Amazon is I do think Amazon will be around. I do think it's a company that is worthy of holding, and I'm not in any way confused that it will survive and continue to thrive in the market environment. Future earnings, you've got some amazing executives at Amazon. Andy Jaffe came from the cloud business. So I do think that he has to prove that he can run the retailing business just as well, but it's not about a single man. It's always about the team. And they have some fantastic people over in the retail side of the business. I'm an options person though. So what I can say for sure is that it should be a very exciting earnings season because it really does set itself up like a particular type of sports game. And so I'm going to stop sharing. That's really what I prepared for today. And go ahead and open up to questions.
Hey, May, it's Dave. Thank you. Excellent presentation. Can you put a multiple on the cloud business?
Sure. So if you were to give it the same valuation as something like Microsoft, then it should be getting a 33 times operating income. So right now, Microsoft is being valued at 33 times operating income. And the reason that I'm using that metric is because if you do it relative to revenue, because the core business of Amazon, which is the retail business, is so incredibly different from the businesses that Microsoft has, not the least of which is that all of Microsoft's businesses are profitable into the fourth quarter. And that was just not the case for the fourth quarter of Amazon's businesses, right? So let's just say you were to give it a 33 multiple. That indicates a significant downside. I'm not convinced that they will experience that downside to the extreme. But with Rivian, it's a 44 multiple, so that would be a huge downcline. And why, from an options perspective, I'm scared of Amazon a little bit, one direction or the other. If we take out Rivian and we truly do it relative to this multiple that it's currently having at $3,200, almost $3,300, right? If I do it to 64, and I was just to bring it down to a 33 multiple, that cuts this stock price in half. I'm not convinced. I think there's too much love for Amazon for it to ever get clobbered that badly, but I can't ignore it either. You know what I'm saying?
Also just lost a union fight in New York.
I didn't know that.
Yeah. So, do you think that would, I don't know if that's a high percentage or not.
Well, to be fair, I don't know enough about what the settlement entails. I would feel uncomfortable speaking about it. I would say the only thing I might say there is that labor costs, they were anticipating to go downwards. So just so you guys can see what I was talking about before, this again was that slide where I was showing the multiples. So here's the trailing PE. So trailing, some people can argue with me on it, and I understand that. That's actually a fair argument. So that's what I'm talking about. If we were to just try to find something where we could do apples to apples with Microsoft, you could do something like this and then make your estimates accordingly. So, not the perfect argument because we should be using forward, but I'll admit that. So on your other question, one of the things that they had talked about in the call, they were expecting to decline was fulfillment costs and cost of sales. Okay. In cost of sales is all of the increases that they incurred trying to make the fourth quarter happen. The oil portion is absolutely going to go to fulfillment. Some of the additional costs on shipping are all going to fulfillment. And as you can see, I don't know if I wrote it here. one of the things that's intriguing about fulfillment costs is it's about a 20-something% increase, which is about the same as your increase on Amazon Prime services. So really, that's what I was in. They were hoping that would cover that. And then some of the labor costs stuff would decline as they exited the fourth quarter and didn't need certain types of help. So it's possible that the union numbers can put a little bit of a mess to anyone that was modeling that, because I'm not sure how big that number is specifically as relates to the unions. Thanks for letting me know. I'll take a look into it. Go ahead, Satara.
So I was just saying that 13 more states signed on.
Oh, so it's a bit more than New York then. Thank you for that. I'll definitely take a closer look.
Yeah, New York was the first.
Okay.
Friday.
Yeah. It's a difficult situation. I'll say that for sure.
Yeah, I think in general, labor costs will likely rise, right? We're in an inflationary period. Companies are offering high wages to attract workers back to the workforce. So I think in general, the labor costs for Amazon will rise. You made a good point about the cash flow valuation that Danny Loeb might be using, because if you think about it, in a rising interest rate environment, those cash flows are worth less. Right?
Yeah.
So I believe that the valuation will need to contract a bit, right? So I'm not sure how that gets resolved, or how, whether the stock goes down and you have a more attractive PE. But I don't think where Amazon is the correct valuation. And so I would agree with you on that.
Yeah.
But I do have go ahead.
No, I was just gonna say, you can't fight momentum sometimes. So getting out of the way is really what I do when the market decides to just go for it, You go ahead, because I'm intrigued what you're gonna say.
Well, my next question was in terms of guidance. You spoke a little bit, but were there any guidance as terms of where they want to take the grocery business, being that they are increasing their presence?
I mean, it was it was a really short call. Like, if you guys go onto the Amazon website, you'll see that it's 37 minutes or so is the call. I was really surprised, because most calls during earnings season, especially if you've got this kind of result, would typically be at least an hour. There's a lot for him to explain, and I'm not sure. I'm just not sure, but there wasn't enough on the strategy to make me feel confident that I understood what he was going to do going forward. There were a few mentions, like they invested in some more retail space, which is on the operating leases side. There's some more vehicles that they purchased, things like that were discussed fair and square. But the kind of thing that you really want to hear wasn't there. And also, he was pretty clear that some of the things would have to go through the second quarter to get fully, let's call it, resolved. So this second quarter, so they're really looking for the retail business to pick up in the third and fourth quarter, not the second quarter, which is why I think that this is going to be a very volatile period for Amazon from now until the third quarter, which is always a little scary when you're doing options, and definitely would bode well for someone who owns this and is in it to win it for the rest of their retirement. And in fairness, Amazon is one of those kinds of names where a lot of people will feel that way. You may want to just buy puts every now and then when this thing gets really excitable. Let's call it that way.
Yeah.
On some cheap exposure.
Or at least if you're
yeah.
holding a position, maybe some type of covered call, synthetic dividend.
Yeah.
We have the book Intelligent Investor, and that's going on now. That'll talk about looking at the income statement and the balance sheet in more detail. The website is not correct. Unless you're truly doing your due diligence, you're going to see that back in USD. Yeah, it's not necessarily corrected, and this is the value then of a presentation like this.
meaning that it's always good to do more work. The Intelligent Investor is an amazing book. That's a real Ben Graham type of book, and you should definitely take a look at that. It's another great reason to join Dr. A's room, live trading, because they absolutely have those types of things on Clubhouse. Definitely take a look at Clubhouse and some of the free resources that there's really good people on that app. Go ahead, Dave. What was your question?
My question is, they're doing a stock split, which causes the stocks to run up, right? Could they be doing that just like a PR move? Because it really doesn't help a company financially, correct?
I mean, it doesn't help a company financially. There would be some reasons that aren't just PR related. One reason would be just to broaden the shareholder base. And that can be something that you might want to do, because especially if you're seeing the liquidity of your stock go down, right? He hates that. I think as a person, it's not his deal. But the A shares as a result are impossible for the common folk to buy, because it's almost $500,000 for you to get it. The B shares, he just created a separate class for people that might want exposure, and there was something he was raising assets for, or raising capital for a while back. So he has no interest in, Warren Buffett has no interest in broadening his shareholder class. He wants you to be in it to win it. With something like Amazon, they have a different sort of situation happening. So they actually probably could benefit from broadening their shareholder base. Remember, there's a lot of executives there that are going to retire and pass on their wealth to their children, don't necessarily want to sell in that manner. Because imagine if you're in Berkshire Hathaway right now, you're an older, distinguished individual, let's call it that way. If you sell one share of Berkshire A, it's a $500,000 capital gain. That might not be what you were trying to do for the year. So there's pluses and minuses how you go and what it is you're trying to do. The other thing that the other reason you might split it is if you tend to pay people in options or something like that, then you might want to do it, because that gives you a little bit more granularity when you go to pay people. You know what I mean? It's a $3,000 a share. It depends what kind of bonuses you were trying to give people as to whether or not that is working out for you. So
I think it's not just coincidental that they see what you're seeing and they say, hey, we need to split the stock to, get public interest into this. I mean,
it's always hard to say. The one thing I would mention is that, and I just want to show you this, every single financial statement will show you what the basic and the diluted share count is. And the diluted share count will indicate the options that are on it. In particular, if you see this, it typically tells you that some people are in fact paid via options. Although there's other reasons why you would have a diluted share count that's ever so slightly higher than the basic share count. I mean, this is really small dilution, to be fair. So I'm not really one way or the other on that. And then it'll also show you how much the shares grew year over year. And realize that I think the $10 billion buyback, if you do the math, it's not really doing very much as far as the increase in share count goes. You know what I mean? So realize that too. The buyback probably is less interesting. The share splitting is got certain dynamics that we all have to be aware of if we have some kind of duration attached to the product that we're working in. Options always has a time component to it, so you can't just ignore it.
That's the issue with options, right?
Yeah, I mean, we can say everything we
right
want.
On time.
Yeah, David, I know you're a longer term investor and you've got folks that are interested in how to think about it long term. So 100% you are right. And also, yet all of us are beholden to this crazy market doing its crazy things.
In the meantime, could you give us, for our audience members, the process you go through for your fundamental analysis of a company? Just kind of a step-by-step, if you're new to investing, how do you go about collecting the information, processing the information, and making an investment decision from that?
If I was to tell this to someone who just first started, it is absolutely the case here in the United States that the companies themselves offer a ton of disclosure. And in a lot of ways, you sit there and you read it, and at first it makes no sense and you feel like it's completely overwhelming and something that you cannot do. I'm going to tell you, everybody feels that way, so it's going to be okay. Just keep trying. But let me just show you, this is Amazon's website. And when you go on the website, this is the investor, you can get to the investor portal, and you should absolutely look through the annual report. You can read the whole thing. The first time you read it, it's going to be painful. I get it. It's fine. It was painful for me many years ago when I started reading them, but then they all follow a very, very specific pattern. And once you learn the pattern, it's like reading anything that you've just read over and over again across all companies. And so the annual report, you can always absolutely read. The annual report includes the shareholder letter as well as proxies and stuff. For Amazon, that hasn't come out yet. The 10K, which would have been filed at the same time that they reported earnings, is also available, and that is here. So the 10K is inside of the annual report, and then the annual report includes a letter to shareholders and a proxy statement. So when you read through this, I just want to show you the table of contents. It will describe the business, the risk factors in order of what management's actually concerned with, and then so on and so forth all the way down. This never changes, okay? It's always these items, always in this order across every single company. So that's the first step. The second step is, while if you're first just getting started out, it's fine to just go onto Yahoo Finance and go to their statistics and just really learn what all these statistics mean. And that just takes time. But all of these statistics can be backed out with another number. The challenge with Amazon this quarter was because of that one-time charge, you ended up with something that looked crazy, 98% earnings growth with only 9% revenue growth. If you're an unseasoned person, it wouldn't give you any kind of hint to just know that something's very, very wrong. For a more seasoned person and for someone that's just accustomed to looking at the quarterly statements, because when I listen to the call, I always review all the documents as well with it. That's part of the reason why you'll notice that in my analysis, unlike some of the others on the internet, you can see that I'm clearly comparing to what it should be worth. That's more relative value. It's a different specific type of fundamental analysis. Nonetheless, I digress. But the news release is always available for you to look at. And it's just over time, especially if some of you guys have inherited these positions from just having them for a long time, or maybe you worked for a company and so they gave you a bunch of stock, whatever it is that might have been, or maybe you had a wonderful person that donated it to your account at some point. So for a lot of people, they're never going to touch their Amazon stock or whatever it is, but you can still look and see what the businesses are doing. All these numbers are public, incredibly public. And also the call is webcast. That's all public in the United States for the larger cap companies. And then there's even presentations, like I didn't make those cash flow items. Those charts are made from Amazon. So all of that is stuff that is fair game for anyone to review. And then just doing the activity over a period of time can help you grow. I don't know if that answered the question.
It did. I would also add sec.gov.
Oh, excellent. Yeah.
SEC.gov as a good resource for finding that information, because these companies have to report it to them, right? In fact, on the investor relations page, there was an SEC filing.
Yeah, it just links right through to the SEC. All of that stuff definitely goes to sec.gov ultimately.
So just a little bit about how do you interpret this data and make a decision based on your interpretation?
Okay, so with Amazon, it was crazy, right? When I looked at the quarter, I was like, this is a terrible quarter, right? In my mind. And that's just, for me, I was really looking at top line growth, which was more or less flat. At that time, you already had enough retailers coming out. You got to remember that a lot of the retailers report the fourth quarter in December so that they can get it right before or like immediately after Christmas and close the book out. Retailers that are more international will report in like October or whatever, and then wait to include the entirety of January. So I already had a bunch of earnings reports that included Christmas in my head. So I was looking for, what is the top line going to be? and what kind of operating margins am I going to see? Going into the fourth quarter, I knew that a bunch of folks made their top line growth off of inflation, and they just so happened were able to get enough costs out of the middle part that their operating margins didn't just collapse. This is the retailer's revenue number. And then here is the retailer's operating margins numbers. And when you do this type of analysis that I'm doing here is, there's more to it. There's more to it than this. So please don't think that I'm trying to, there's people that do this for a living in the real way. And if they saw this, they might get upset with me. But relative value is a legit way to compare across companies. How are they doing? Because if you think about it, and this is something that the folks at Gurula always say, money always goes to where it's treated best. If we're talking about who's the best retailer or who's the best what have you, and if you think in your mind that the best retailer should receive the highest multiple, then it implies that you also got to do a little bit of time with the other retailers to get to know what's going on in their business. So I was looking for a particular set of discussion. I didn't get it, which is why I was like, this is a terrible quarter. Because you got to think, out of everything that's been said about Amazon and why it's so fantastic and all these other things, right? The one thing is that it's just cheaper than everybody else. So I would have thought TJ Maxx was going to be the place that you would compare it to, and that we would just see this amazing operating benefit because TJ Maxx has actual physical stores. Instead, TJ Maxx just absolutely killed the quarter. Do you know what I mean? Like they had top line growth of 20-something%. Bottom line growth was, you can't even compare it because the previous quarter was just so bad. There was no store traffic. But even all things considered, it was just a wonderful, wonderful quarter. And in fairness, TJ Maxx had been doing that all year since Christmas of last year. All year they'd been doing that. So I kind of, that's what I was looking for. I didn't get it. And then, it became very apparent that earnings per share, which some people had initially reported as blowout operating one-time charge, which will absolutely go away after this year, So that's kind of what I was looking at. I don't know if that helps.
I can appreciate. I was trying to get to, just to help our audience understand the process, right? Reason you want to do fundamental analysis and understand what a company is doing. The numbers can tell a lot, right? I know from my accounting and finance classes in college that you can, from a balance sheet, from an income statement, understand where a company is directing, right? Where it's going, whether growth is more important to them than profit or earnings right now, right? Which is the case with Amazon, right? They're just totally focused on growth. So I just wanted to give our audience that sense of, if you're going to do fundamental analysis, which you should, understanding what to look for, how to interpret the data, and using relative performance like you did with other companies in order to make a decision.
Yeah, and for us, timing is everything. So when we're interpreting how does the stock move in the aftermarket and then the next day, that's also really relevant. Because if we look at the chart on Amazon, I wish I could bring it up faster, but Amazon has moved, I think it's gone as low as back to 2,800 pre-earnings, and then it tried to make a run downwards and then has now bounced back up to 3,200, 3,300 almost, so I've got to think to myself, just like, I know you do too. It's like, who's supporting this? Is this really fundamental people? Is this growth people? Who are the people that are running this thing up? Given that was the earnings that I saw, and what are they thinking? What am I missing? From my perspective, if you're a value, deep value, or just pure, like I need it cheap sort of perspective, that's a really hard one. If there's people that are coming in for that, I'm not sure that I understand their argument totally. If you're a pure growth person, like you said, I can appreciate that You might think the web services business is worth a whole lot more because the growth rates of businesses of that nature are very unknown. You might get like a short-term blip because we got some things going on and then it just takes off. And in that regard, I would hope that you also feel that Microsoft's business is also undervalued. You can't usually typically just think it's one business is undervalued and every other competitor is just nonsensical, which is why I did the calculation on operating margins to compare the two businesses a bit. So you can start to try to get some feel for the size of those two businesses and what maybe the two of them ought to do. I know that's not necessarily like when you're first starting out, it's really, really good to learn just one company that you love. If you got skin in the game, there's nothing faster than having skin in the game to make you learn very quickly. And you really only need one share. Let me tell you, one share is skin in the game. This thing moved $300. Do you know what I'm saying? $300 is still a nice dinner for your family. Let's just call it what it is, right? One share is just one. It doesn't even matter how many shares you own or how you're doing it. But skin in the game will always make you learn things really fast. Choosing the second company to learn can be very strategic if you're trying to build your knowledge base. And so if you learn Amazon and then you learn Microsoft and you started to compare how those two look, not only in their business strategy, but also in how are they running these businesses? What's the profitability of one operator versus another operator? And you'd be surprised how fast your knowledge base just grows and grows and grows. I would say, though, if you chose Amazon and Microsoft as your first two companies to learn, more power to you. These are hard companies to learn. Do you know what I mean? They're like multiple different types of business modules in them, that sort of thing. So it's not the easiest. You guys are very ambitious if that's what you've chosen, but I'm never going to stop someone that's ambitious from trying to achieve their goals. If anything, hopefully this tutorial helps you a little bit.
You said Levy on it was a charge. Was it not a revenue?
Oh, sorry. You're right. I said it wrong. Thank you for correcting me. That's correct. It was it's a one-time gain. You're right. One-time gain. Thank you. Sorry for anyone that misunderstood me. Good point.
Okay. Also, why do you think Amazon sales were down the fourth quarter? I mean, there's got to be a reason.
You know what? I still don't totally understand it, to be honest with you. I think it might have been that, so the third party sales were up 11%. So as far as retailers going on the platform and doing great, that was okay. But their own items in the retail business, there wasn't enough for me to really appreciate and understand what it was. And that's part of, hopefully this next call is more than 37 minutes and they speak to the retail business a bit more. But yeah, it's a good question. I would also mention that, Andy Jaffe's only been the CEO for a few quarters. And the first one, I was very disappointed that he didn't show up. The second one, which was a miss, he showed up and spoke a little bit. And then this last one, it was just a very tailored 37-minute call. Each call hopefully gets a little bit better and a little bit more down to the nuts and bolts of what's going on. So hopefully, and that is the one thing as an options trader you always want to be aware of is, what whammy could the next call bring you? And so if I was to play earnings next season, depending on where this stock ends up with, I would probably do something very chicken, like an iron condor or something, like a reverse iron condor with vol blowing out. Because what I do see in this stock is a desire or an ability, let's call it an ability, of the marketplace to trade it down to 28 and trade it up to 36. And as an options person, you can't be oblivious to the two data points of where the wings of what has actually happened for this. But that's, we're going to just have to wait and see how close it gets and where it moves to between now and earnings.
Yeah, could it be people, they benefited from COVID, obviously, people shopping at home.
You mean
now
from the year previous?
People want to go out, and maybe if you get a better deal out in public, you're going to do that versus shop online.
Yeah. And, I wish I would have put this slide in here. One of the things that is always interesting is that you'll see a lot of analysts talk about, more of my purchases are coming from Amazon, more of my purchases. And I just want to remind everyone that women by far make up the larger lion's share of consumerism. I wish I had my slide, but this slide hasn't moved very much, but it's something like 70 to 80% of purchases are made by women. Somebody can maybe Google it and see this, but this is 100% Googleable. You don't have to take my word for it. Women make up the lion's share of all purchases. I think they make up 60 something percent of even electronic purchases. So even there where the men might feel like they are all about the whatever it is, there's not an area at this point that I'm aware of. Maybe there is one little niche area that women don't make the lion's share of it up. And, you know, you just have to ask women, where is it that you prefer to shop, outside in a store to try it on, or online? And I'm not saying that I haven't moved my purchases to online. I certainly do buy a fair amount of everything online. I think I might be more of an anomaly because I think a lot of women try clothes on. I think they go into the store and do comparisons, et cetera, et cetera. If I'm wrong on that, I would say that a lot of the retailers in the fourth quarter did great. So even though I selected the ones that I thought were most comparable to Amazon, which is like a Target and a Walmart, and then a TJ Maxx and a Kroger's, the fact is specialty apparel did great. Nike blew it out the top. Ralph Lauren out the top. You know what I mean? And then you just go through all the different specialty niche retailers, and there were some really strong earnings reports coming out of the fourth quarter, which indicates what you're saying, which is people went out and shopped. So,
retail is 75% of their revenue.
Yeah, and it's interesting because people will argue with me from time to time that the core business is not retail. And I'm really surprised. It is definitely not the highest percentage of operating income. And it kind of depends on, there are some folks that will say the core business is the largest component of operating income. I think that's probably not the right way to think about it. If we look at where the expenses are running through to on cash flow, et cetera, most of the revenue and also where the expense lines run into the business is still the retail business. So like all that fulfillment costs, marketing costs, all that stuff is all going into the retail business.
Let me add that while these are good points, in an inflationary environment with rising interest rates, that is targeted to breaking down demand side of the equation.
Yeah,
that becomes a problem, right? So you know, they're attributing a lot of this inflationary pressure to supply side, but the Fed is going to be reducing the demand side. So
it's a really good point. It just means that, you know, Dr. A, us options folks, we're gonna have our work cut out for us in this next quarter. It's gonna be like any person's guess. It's almost like I find a lot of the, you know, most of the videos you'll find online or most of the rooms are going to be talking and setting things up as like, it will definitely go up or it'll definitely go down. But the beauty of being an options person is, well, seems like a lot of people will think it's going to go up and a lot of other people think it's going to go down. And they're both really passionate about it. Options land is the place to be.
Yeah. Well, selling premium, right? I think that has worked for Amazon. Yeah, because if you look at the past 2 years from a chart perspective, it's really been range bound.
Yeah.
And so, you know, to your point, you know, an iron condor, you know, just basically strangling the stock within that range has likely worked.
Yeah, I mean, it's so, you got to be so careful because the thing moves. I mean, it almost feels like Tesla some days when it's moving recently. I'm like, what happened? You know, so to speak. But yeah, and then depending on where this thing settles in front of earnings season, you can get a sense for the controversy. I mean, I think if it settles between, if it's above 3,000 going into earnings, I think that you might want to consider a straddle or a reverse iron condor where your bet is that this thing blows out one direction or the other. But we have to kind of see where it settles. Right now, it's a little bit early to put on such a bet. You just have so much decay from the theta that it might not be worth it so much. I mean, maybe, I don't know. But I don't know. Could be fun, right?
It will definitely be fun. Go ahead, Liz.
We do have one question. So it says, outside of major market mover companies like Apple or Amazon, how do you decipher which specific companies to take a deeper dive fundamentally into?
Oh, wow.
Do you have an ongoing high-level market narrative, then decide which sectors you want exposure to?
Okay, I'm a complete weirdo as far as things go. I literally listen to 400 calls a quarter, and I will review the documents while I'm listening to them. It's just something I've been trained to do. It's a really strange thing. So if you're talking about what do I do, that's what I do. That's part of the reason why certain things might come out the way they do with me. If I'm telling someone who's new to this and trying to just learn the next step, I actually think it's better for you to pick a reasonable size company that has not so many variation in businesses and has a 10K that is of a reasonable size. Now, what do I mean by that? Okay, something like Netflix is a wonderful company to learn how to read the 10K and learn how to even get in there as far as what these fundamental things are going on. And the reason I say that is because a lot of people have direct experience with Netflix. They're watching Love is Blind, they're watching The Witcher, stuff like that. So there's a very direct experience that you've got with Netflix that allows you to latch on to what the CEOs are saying. And then from there, that 10K happens to be written extremely well. It's a very straightforward. There's not a lot of extra words. They really describe out their businesses. They do all the different geographies a certain way. And you want to just kind of find companies that are like that. Now, if you go too small in cap stock, what I mean by too small is it's under 100 million. Okay. Then it kind of depends how well that company has written their 10K. So what you can do is you can pick a really small company that's under 100 million and then pick what you think is a comparable company that's a bit larger. So let's say if you were picking XYZ, some really small retailer like a Chewy or something like that, right? I mean, that has a lot of cap size. So just some new exciting retailer that let's say that they do sneakers or something, some new exciting sneaker company, then you might also want to read Nike's 10K and then just compare them. Because remember, the section by section, they actually have to list it almost identically. So you can absolutely just read, okay, how does Nike talk about the business of sneakers, and how does my company talk about the business of sneakers, and just sneakers, and then just compare them straight on down, and so that you can kind of make sure that you understand what disclosures ought to be there and how the different strategies kind of match up. And that's a very great experience for anyone that's still trying to build their knowledge base to do.
With that, if there aren't any other questions, I want to go ahead and thank Mei Ling for gracing on stage and presenting such an insightful presentation for our community. Thank you. Appreciate it.
Thank you for inviting me, Dr. A.
Anytime. We appreciate you being in our room and all the value you bring and insights that you bring. So anytime. Thank you to our audience members, team, of course. Can't do it without you. We appreciate you being in the room. This doesn't happen without you. Constantly thinking of ways to bring value to our community. This is just one way, and we're going to continue to do this. But without you, without the audience, there is really no us, right? No community. So we appreciate you sharing your time on a Sunday morning, on Sunday afternoon, and hope that you will join us again on a future date.